Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
ISE FX option pair values, dollar-based. How do we get those numbers? Well, we take the exchange rate, we multiply it by 100, and come up with the ISE pair values for illustrative purposes right here. Now, with the dollar as the base currency, did the same thing. A couple of them are modified not at all. Let's say the yen is the only one that's not modified at all, but the peso and the Swedish krona are actually modified only by 10, not by 100. So that's how we get the exchange rate pair value. So we take the exchange rate multiplied by a rate modifier to come up with an options underline. I hope that makes sense. And that's really how the strike price are determined, and you could select from the various strike prices. Option Greeks, what are they? They help investors get a better understanding of the risk of owning an option or selling an option. They can further help you, the trader, set your market expectations. Really important. So you'll be able to get a better understanding of all the different Greeks. And I'm going to go through the Greeks over the next half hour or so. I'm really looking forward to this because I think the Greeks are so important for people that are trading options to have a reasonably good idea of what these Greeks mean. You don't have to derive the math behind the Greeks, but it does really help to understand what happens if the underlier moves, what happens, how much will my option move? What happens if nothing happens over a certain period of time? So it's how your option will react theoretically to changing market conditions. Options are based on statistics, the likelihood of an event to occur. So when I think about statistics, it's sort of strange because the options pricing it does conflict with technical analysis, Technical analysis believes that we can, if you do believe in technical analysis, that you can look at trends and predict the future, whether it's an uptrend or a downtrend, however you look at it. That's at least the theory behind it. In fact, John Yeagerson is going to be talking about next Tuesday, if you're interested in Fibonacci, FX options entry and exit points using Fibonacci analysis. So I'd urge you all to come back next Tuesday, listen to John, and John will be talking about Fibonacci. So Fibonacci actually takes into account technical analysis, and then he'll explain the Fibonacci analysis. But these kind of analysis are in conflict with options theory. What does it mean for us? Well, if you believe in technical analysis, then it even gives you a better chance, if you will, to trade options, because if you think of the options theory says that the next day, let's say tomorrow or whatever, next week, it's just as likely for an exchange rate to be moving up as moving down. If you believe in trends, you don't believe in that. Right? You believe that maybe the trend is going to continue, and that gives you an opportunity. So understand that options are based on reversion to a mean. Now let's get back to the option Greeks. A couple Greeks, were actually 5 of them: delta, gamma, theta, vega, and rho. I have a question for everyone in the audience today. Which Greek, if you can only learn one Greek, which is the most important Greek to learn? And of course, you should learn all 5, but I'm just trying to If you don't understand the Greeks at all, yes, thank you. Some people, and you know what? I hate to say that, some people are not giving, the answer I was looking for is delta. And the reason I say delta is the rate of change of my underlying versus the option. That's going to tell me how much, my option should change. So if the underlying moves a point, how much will my option move? The rate of change. So I think, quite frankly, that this is the most important one, at least initially, to get your hands around. Delta. Now, some of you actually said gamma, and gamma is very important. Gamma tells me, if you will, it's the delta. How much will my delta change? Because the delta at expiration, believe it or not, options don't have delta at expiration. They're either worth zero or their intrinsic value. Also, delta, if you look at the delta on a graph, it's not linear. Makes sense, right? As the underlying asset's changing, you're going to have different deltas. So it's really important to understand that my delta is going to change each day based on where the underlier is, also based on time, how much time's left to expiration. Theta is going to measure how much my options should decay per day. Right? Maybe I buy a 9 or 10-month option. Maybe I buy a 9 or 10-day option. The 9 or 10-day option is going to have greater decay per day. Vega, this last year, 2009, Vega is so important. Why? The market started to price in the expectation of lower volatility. What does it mean to all of us as traders? Well, it means that since people were becoming more willing to accept risk, they were less willing to buy options, and they were more willing to sell options. So option premiums started to decline in just about every asset class, including currency options. And the way that we measure declines in volatility and their effect on the option is called Vega. And lastly, the interest rate differential, or rho. The rhos are, can be very, very important. Right now, interest rates are pretty low, so we don't see a big effect right now, although in the future you might see interest rate differentials that are much wider than they are today. FX option pricing inputs. We know that we look at the underlying exchange rate. We multiply it by either 110 or a dollar against it, looking at the U.S. dollar against the yen. We don't modify it at all, but that is the asset value. Then we have the strike price. You select that. How much time's left to expiration. The IRD, the interest rate differential. Very important factor. Volatility, extremely important. Because if you think about it, if I had very, very low volatility, I'm just going to put L, low. I might look at, let's say, the assets trading at 100, parity, let's say 100. I might see that 1 month options might actually be 60 cents for the call and 60 cents for the put. And then I'm going to have another column here, or row, high, and then it might be $1.60 for the call, $1.60 for the put. And what am I saying here? What I'm trying to say is that volatility is so, so important. So if investors are scared, they're nervous, they want limited risk, they're going to bid up options from that 60 cents up to some other number. And if they're more willing to tolerate risk, they might sell options and then drive the prices down. So that's how that volatility impacts options pricing.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.